So good morning to you, and thank you for all joining. I'm really excited about today. We have two great speakers, and we have an incredible topic. Many of you have heard about premium finance. As a matter of fact, last night I had dinner with a very seasoned broker who said, I've heard about premium financing. I wish I knew more about it. I hear about the large commissions, I hear about the large premiums. And this is a gentleman that's been in the business a very long time. And so he's really interested in hearing him. So our guest speakers today, our first speaker is Benjamin Weiss. He is a partner with Strength Insurance. He's one of the youngest, brightest insurance minds that I have ever met. And I've been in the business almost 45 years. In addition to being bright and understanding the business really well, he's also a mega producer and an expert on premium finance. He's been able to submit multiple millions of face amount and multiple millions of commissions through premium finance. And our second speaker is Mark Storms. Mark is the VP from Wintrust, is one of our great partners in funding these premium finance cases. So we have the A team on here today, and at this point, my brother from another mother, Benjamin Weiss. Benjamin, please take the lead.
So first of all, thank you, Vince, for the compliments. Just a little bit of background about myself. I joined the industry at the end of 2018, and I've been doing premium finance since the end of 2019. I think that over the past years, we had the biggest shift or changes in interest rates in percentage-wise is back and forth that we almost ever had. And sitting here a few months later, and every piece of business that I manage is still on the books is something that I'm very, very proud of. Before I turn this over to Mark to go through and hear what Wintrust is all about, and Wintrust is a great, great partner. I just want to say one small thing about it. There are so many banks doing premium finance. There are hedge funds. There are just so much. There's so much going on in that space, and for someone to just be able to define exactly what they stand for and what they're good at, that's not something we find every day. But Wintrust is a very, very clear defined program, and it works as smooth, efficient as anything else can do. So we're very excited to the partnership we have with Wintrust. Two comments I want to make before we go into this. Premium finance is neither of these two things. It's not free insurance, and it's also not an arbitrage game. Again, it's not free insurance, it's not an arbitrage game. It's a way to buy insurance that's much more efficient, that so wealthy clients can have the insurance they want or need, in a way that doesn't just drain their cash flow. And with that, I'm sure there will be questions going forward. With that, we'll just turn it over to Mark, and that's it.
Great. Thank you, Benjamin. And Mark, before you go through the presentation, if I could just mention to the group that this webinar will not answer all of your questions. It's about to give you a overview and get you excited about it. However, on May 14th, we will run an in-person event, probably in New York. And for those people that are not in New York, we'll Zoom it. So please mark your calendar. Mark will be there, Benjamin will be there, Chris and I will be there. So it'll be a great event. So May 14th, you'll get more of a deep dive, couple of hours, but this is more to get you excited, give you an overview, and I'll now turn it over to Mark. Mark, you're up.
Thanks, I really appreciate it. Can you guys hear me okay?
We can.
We're good? Okay, thank you. I really appreciate it. Thank you for your time today. What I would love to do is kind of give you guys a little bit of an overview of what I've been seeing over the last couple of years, what's working, what's not working, answer some questions also. So with premium financing, it's kind of interesting. We saw interest rates spike up. And, they've leveled off a little bit. A lot of people are expecting interest rates to go down further. Some people are thinking they might go up. The one thing I can tell you about interest rates is that I've been doing this. Today is my 22nd year in this industry. And for 22 years straight, I have been wrong about interest rates. When I thought they should have gone down, they've gone up. When I thought they were going to go up, they went down. So I don't know what's going to happen with interest rates. What I'm here, though, is to show you a couple of different options that might work out best for your high net worth clients. So just real quick, what Benjamin was saying as far as with premium financing, it is not free life insurance. And we've got to be really clear about that. Back when interest rates were at sub 3%, there was a lot of producers in this industry selling it as free life insurance. Telling clients that, hey, I can get a loan at 3% and the dividend rate is higher. So look at this great arbitrage that I made you. Aren't I great? And I would tell those producers, please don't sell it that way because you have just sold something in a form that you have no control over. You don't have control over the dividend rates. You don't have control over interest rates. Where you might have a positive arbitrage today, you might have a negative arbitrage the next week. And that's exactly what we saw. When interest rates were at 3%, everybody was an expert at premium financing. Today, interest rates are a little bit higher, as we all know. They were much higher a little bit more than a year ago, but we have seen them settle down a little bit to a point where it really makes sense for the right clients to do premium financing. When interest rates were spiking up, I remember thinking, who's going to do premium financing in this high interest rate environment? And boy, was I wrong. What I found is that the rich were still rich. They were getting richer. They still needed life insurance, and they still didn't want to pay for it. So premium financing for the right people made a lot of sense. And what we saw was that we did a tremendous amount of deals. And I'll get into that also. So with premium financing, one of the things that I really like to show is that it's all about the options, right? At the end of the day, you sell the life insurance. You talk to the client about that point of pain that they have, their estate plan, their business succession plan, buy, sell, key man, whatever that situation is and how life insurance can help solve those issues. And what we have seen over the 22 years that I've been doing this is that a lot of clients agree with you. They agree that they've got this need for life insurance. And usually at some point during the selling of the life insurance, the client goes, you know what, this doesn't make sense for me. And typically that's because of cost. They see what the premium is. The client starts thinking, I've got better use for this capital. I'd rather keep it invested in what's making me high net worth today, and I don't want to disrupt it. So let's just take a sample case. This is really typical. And again, I've been doing this for a long time, and I've seen a lot of premium finance seminars. And usually what the presenter will tell you is that they'll show you an illustration of, 20 columns or 40 rows, and they'll say, if you could see this, this is what it would say. So what I did was I went and I picked out a couple of the pertinent rows. So let's just take a look at a 10-page scenario. And typical premium is about $1 million per year that we're seeing. Just so you know, with Wintrust and with most of the carriers out there, the first year loan needs to be at least $100,000, and the client's net worth should be at least $5 million. There are some carriers that have increased that amount. So whatever the carrier says is what we'll abide by. But for Wintrust, those are our two requirements: $100,000 of first year premium. Year two could be $5. It doesn't matter. And the client's net worth needs to be at least $5 million. So let's just say what we're seeing today is that most of the loans are coming in a little bit higher than $1 million on average. But let's just take $1 million because I was a state school kid and round numbers are easier for me to do. So at the end of 10 years, the client ripped $10 million out of their stocks, their bonds, their corporation, whatever the situation is. And a lot of our clients, they look at lost opportunity. What could that money have done for me other than buying life insurance? Well, at just 10%, that lost opportunity compounded annually comes out to almost $17.5 million of lost opportunity by writing out those $1 million checks for the last 10 years. It's pretty substantial. And, I use 10%, and I personally think that's a high number just because I'm a very conservative banker. But what a lot of our clients have told us is that 10%, they'll blow that number away. A lot of our real estate developers, they're in the 20% range right now. So they're doing phenomenal. Talk to your clients that own franchises. It doesn't matter if they own 2 franchises or 200 franchises. They want the next franchise, and they're doing really well on those franchises. The franchisee owner that's out there, real estate developers, car dealership owners, doctors, lawyers, accountants, those C-level employees, we're seeing a lot of premium financing from them because they've got better use for that capital. But they do know that they've got a need for the life insurance. So writing out a check for $1 million per year equates to a lost opportunity at the end of 10 years for about 17.5 million. So what we want to do is we want to give the client the option. If they can write the check, I always recommend get the check, because maybe the client is okay writing that check this year and next year, but maybe in year 3, they've got a problem writing out that check for $1 million. Well, I don't participate in your commission. So I can jump into this transaction in year 3 and start paying those $1 million premiums for the client at that point going forward, because maybe they found a project at that point that they want to invest their money into. A lot of real estate developers, they go ahead, they leverage everything, and then maybe after 4 or 5 years, they sell an apartment building. They're flush with cash, they pay off their debt, and they do it all over again. So maybe for that client, that's year 4 that they want me to jump in and start paying their premiums. We can do that. So give them the option, write the check, or let's have somebody else write that check for you. And the client would just simply pay interest. In this environment right now, what we're seeing on a loan this size, the interest payment is really a little bit lower than 6% that we're seeing. But again, state school kid, I want to keep this as simple as possible. So here in year 1, they're writing out a check for $60,000. As we do more premium, the principal grows, of course. And if the rate were to stay at 6%, and by the way, the 3 and the 5-year fixed rate, the last I saw it, was right around 6% that we're looking at. So we kind of know that the rate will be at that number for maybe the next 3 years if the client wants to do a fixed rate. Most of our clients are simply doing floating rates because they believe that rates are going to go down. I don't know again, but I'm happy to give you the tools to take to your client to show them the floating rate and the fixed rate. But if they were to just write out the interest check over the next 10 years, the hypothetical 6% all years, which we know is not going to work, but this is all we have to go on today. At the end of 10 years, that's $3.3 million that they wrote checks out for instead of the $10 million. The difference, the money they never sent to the insurance company, stays in their company or their stocks, their bonds, their real estate. So in year 1, instead of writing out a check for $1 million, they wrote out a check for $60,000. $940,000 stayed put. It did not move. It stayed in that investment. And that money growing at just 10%, compounded annually, at the end of 10 years equates to $12.5 million. So here, the client is getting the insurance that they truly do need with minimal effect on their current investments. So again, if they were to write the checks, that's $10 million in checks that they're writing at the end of 10 years with a lost opportunity at just 10% of 17.5 million. Or we can give them an option, write out checks for interest of roughly 3.3 million, keep 6.7 million invested in their corporation, stocks, bonds, real estate, which at the end of 10 years equates to about $12.5 million. It's a pretty powerful little slide that I have here. And a lot of my producers have taken this slide and they've used it in their presentations or a form of it. So I'm not reinventing the wheel. I'm not splitting the atom. So if you guys want to do something like this, that is fine. Just make sure you have the proper disclosures on it. I always tell people to make sure that you're working with a professional such as Ben Yeoman and with the carriers to make sure that they're okay with it. So let's talk a little bit about interest rates. Interest rates are pretty interesting right now. A lot of people say that interest rates are high. So since I started doing this back in 2004, this is the interest rate environment that I've seen. And it's kind of interesting when you look at this, people go, oh my God, interest rates, they're so high right now. Well, this is what interest rates had been. And it's like you look at the blip at the end of this slide, it really doesn't look that bad now. Right now, I think we're in a pretty good interest rate environment, especially for premium financing. It would be nice if interest rates go down a little bit more. It just helps us a little bit more. I want to do what's best for the client, of course. And if we can get that rate down a little bit more for them, yahoo! It's everybody wins in that situation. But when you look at rates, they were substantially higher years ago, and right now they're in a pretty good area. What we're seeing right now, when we look at the forward curve, it does show that interest rates are relatively flat. It has them going down to smidge and then coming back up. Basically, at the end of the day, even the people who follow the forward curve don't know what's going to happen. So again, we hope that rates go down a little bit more for your client. But for the clients that are concerned about interest rates fluctuating, going up and down, we can cap rates. So if your client tells me that they don't want the rate to go above 6.25, well, we can go ahead and we can cap the rate at 6.25, and now they know that it will never exceed that point for the next so many years. Maybe it's 3 years, maybe it's 5 years, whatever your client is looking at. And we can do fixed rates. But there are pros and cons to doing both, and we can get into that a little bit more on May 14th. So who are we? It's like I don't want to just do premium financing this presentation as if it's a commercial for Wintrust, but I do want you guys to know who you're working with, and it is a real bank. We are a bank out of Chicago. We're a $71 billion bank, so it's pretty substantial. I think we're in the I think we're a top 40 bank. It might be even better than that right now, which is great. So we are doing really well. We're seeing a lot of deposits coming in, with Wintrust. So the life insurance premium financing department has 9 billion of that 71. So they really like to keep us around that 17% of their total outstanding loans. So as the bank increases deposits, they do want us to grow with them. So right now we've got a mandate from our CEO to do more premium financing, which is good news for you guys. So we've been doing this since 1995 was when we first did our first life insurance premium financing loan. So it's pretty cool. We did it. It worked. We've been doing it ever since. And today we have $9 billion worth of life insurance premium financing loans. We think it's more than $30 billion worth of death benefit. So is premium financing working? Yeah, it's working, for the right clients. And what we saw last year in 2025 is that we had 432 deals that were submitted to us. Now, some of those deals were people just kind of throwing something against the wall, right, to see if it would stick. But out of those 432 deals, 288 of those closed last year. And it's kind of cool because a lot of those deals, the difference between the 432 and the 288, rolled over into 2026. So we're still working on them. So we have been able to get deals done. And what we saw is the average cycle time was about 65 days. Now, the average time from the time we actually get a full submission is less. So that's the average time of somebody just submitting something to us. And a lot of times we're missing documents. So what we see is that when you're working with Binyoman is that typically it's a lot less as far as the days that it takes to turn these around. We can get these done in roughly about 30 days with his expertise. What I saw also earlier in the year, I actually got a deal done in 1 week. So from start to finish. So I got the deal on a Monday. The client was having some issues. They needed it funded by Friday. It was a great producer that we were working with, and we did get it done. I also got a deal done in 2 weeks earlier this year. But typically what I'm seeing right now from start to finish of a full submission is taking us roughly 4 to 5 weeks to get done. So out of those 432 deals, which actually we funded 288 of them, for me, I take care of the East Coast, so Maine to Miami. I closed 102 of those deals for $159 million worth of first year loans. And my renewals, my subsequent loans, where they're showing 1.3 billion in my territory, I did almost 430 million of that. So pretty substantial what we're seeing on the eastern side of the country. We're doing a lot of deals in the New York City metro area. We're also doing a tremendous amount of deals down in Florida right now. So we do see quite a few coming from there. So there's a lot of value when it comes to premium financing to the client. There's also a lot of value to the producer. I had a producer several years ago that did a deal with me. He was out of Columbus, Ohio, and he understood premium financing. He got it. And what happened was he kept bringing me deals that just didn't fit. They just didn't make sense for us to do. I would turn back to him. I told him, like, Gary, let's just get the client to write the check. Well, one day he had the right client. And the right client, he owned a couple of Mercedes-Benz dealerships, and he was looking to purchase number three. And what he wanted to do was to get a substantial amount of life insurance, but he didn't want to disrupt his assets for that number three Mercedes-Benz dealership. So we did premium financing. It was beautiful. It worked. We closed the deal on December 28th of that year. Gary made $800,000 on that deal. So I always tell the producers, please don't tell me what you make on these deals because I'm a corporate guy and I get jealous. So there are some big ticket items. But what Gary did was when he closed that deal, he took that deal to every single financial planner, estate planner, CPA, attorney that he could find in the Columbus area, and he showed them what he did. And then all of a sudden, he started getting all these other deals coming to him. So there's a lot of value to the producer. It adds credibility to your practice. It could potentially increase your lifestyle because of the size of these deals. And it increases your credibility among your peers where people start bringing you deals now as well. So there's a lot of value to the client. There's a lot of value to you in doing premium financing. On May 14th, we'll get into exit strategies a little bit more. I do see people showing exit strategies a lot more today than they used to in the past, which is great. We're managing expectations. And also what we're finding is that the exit strategy that you guys showed today may not necessarily be the exit strategy the client uses. But the good news is that when you're working with the client and you're doing your annual review, my producers that I'm working with are bringing it up to them about the exit strategy and how it could change. So there's a lot of information. I'm trying to keep this a little bit tight, to the 12:30 mark. When it comes to Wintrust, there are no fees. There's no prepayment penalties on our floating rate loans. There's no relocation of assets, and I never participate in your commission. So we've been doing this a long time. We have just under 100 people in our back office that do nothing but life insurance premium financing. So you're working with the experts, and we will get these deals done for you. The cool thing is there's no relocation of assets, which is great. When it comes to collateral, these are fully secured transactions. So if you're using a whole life product, I will use the year-end non-guaranteed dividend rate as part of my calculations for collateral. Any exposure, so my loan minus that number is exposure, and I would need outside collateral equal to that in the form of a letter of credit, cash surrender values of other insurance policies, money market accounts, CDs, or marketable securities. So we do a lot of marketable securities, and we value those at 2-to-1 until we see what the makeup is of that portfolio. And then we're able to go ahead and make an adjustment. Near cash investments, investment grade bonds, blue chip stocks, it's going to drive the valuation up to 65, 70, 80 cents on the dollar. So a lot of information that I'm showing you guys in a short period of time. And again, we'll get into this a little bit more in detail on May the 14th. So this is a little bit of a breakdown of some of the trends that we're seeing. Last year was kind of a unique year. Whole life policies only accounted for 19% of the deals that we do. Usually in years past, I saw that around 30 to 35%. And it's not because I'm saying IUL is better than whole life. What we're seeing is that there's a lot more carriers that promote IUL. But even with that, I was surprised that whole life had a little bit of a downturn last year. And I'm starting to see a little bit of an uptick on that this year. So hopefully we'll be able to beat that 19% this year. For me, I don't care if you use whole life, IUL, or what have you. Whatever makes the most sense for your client, we're going to go ahead and create a loan to wrap around that. But I do see some really good things coming from the whole life market right now. So in conclusion, guys, it's all about options when it comes to doing premium financing. Write the check or do premium financing. Maybe it makes sense to do private financing where the client writes the check to themselves. But the important thing is let's sell the life insurance, get the life insurance sold, and then bring up the different options. I've had a lot of producers over the year that bring up premium financing as a way to sell life insurance, and typically that doesn't go over too well. So sell the life insurance first, and then let's figure out a way for them to pay for the life insurance. If they just simply write the check, maybe that makes the most sense. Again, if we do premium financing with our floating rate loan, there are no prepayment penalties. So if I do year one loan for $1 million or whatever that number is, year two comes around, I'm ready to send that money to the insurance company. But before I do, I circle back to you and your client and I ask, do you want me to pay this year's premium? Typically, people just simply want me to do it. But when interest rates were elevated, I had a lot of people that went ahead and wrote the check themselves, or we did a split. So there's a lot of flexibility in doing premium financing with Wintrust because we allow you and your client to get in and out of this transaction as you and they see fit. Of course, I would love to do premium financing for every single deal that's out there, but it typically doesn't make sense. So when you have the right client that is concerned about lost opportunity and their capital, let's bring it up. Because that lost opportunity can be substantial at the end of 10 years. And instead, let's see if we can get them to write the interest check instead, and they keep the majority of their assets invested in what's making them high net worth today, which continues to grow. So with that, what I would love to do is to turn it back over to you guys.
Chris, you have some questions from the group?
Yeah, guys, if you have any questions, type them in now. We got a couple minutes left. Mark, are there any any carriers that Wintrust does not work with? And I believe that question is coming from a Northwestern Mutual guy.
So no problem with Northwestern Mutual. We've done a lot of their deals in the past, so thank you for bringing that up. There are some carriers that are out there that are not highly rated, or they don't have the ability to support the transaction. I don't want to put anybody under the bus, of course, but I've had some situations with a couple of pretty big carriers. They have a premium financing department or committee you have to go through. And that committee only meets maybe once every week or two. And that kind of drags down the transaction. I don't want to say they get too involved, but at times they try to micromanage it a little too much. But then I've had other carriers that just don't have the support at all. So we don't have anybody to talk to get the assignment done on the policy. So what we'll do is that we'll work with you, with the carriers. We'll try to get this done. If you're really dead set on using that carrier that we're having difficulties with, just, try to remember, we're going to do our best to get the deal done. Typically what we see though, the Mass Mutuals, the New York Lifes, the Lincolns, the big name carriers, no problem whatsoever. It's more of those little boutique type carriers that you might have issues with. So that's the big thing, is that we want to make sure that they have the ability to support the transaction.
Great.
If I could just get in on this one for a second, generally speaking, if you're designing a policy to do premium finance, especially if it's done like with me, if someone like me, generally speaking, we just know which carriers to use, which carriers works, which policy would work, how to design it. The same goes with which bank to use also, but you just have to know what you're doing basically. But most carriers
Absolutely.
are around, and the A-rated carriers across the board, basically, we can just do it.
I think that
It's funny,
feeds into the
Benjamin.
next question is that someone's asking, can we go directly to Wintrust? Do we have to go through you guys? Can you give me a little color on that?
So at the end of the day, I'm just a lender. You kind of get what you pay for. I'm going to try to help you as much as possible. If you come directly with me, I'm sure the carriers will help you as well. What we have found is that there's a lot of value in using a mentor. So typically what we find is that utilizing a mentor, these deals get closed quicker. They typically get closed for a larger face amount. Because once that mentor gets involved, they're able to maybe identify different carriers. Like Benjamin was saying, they're able to restructure the deal. So there's a lot of value in going to it. But if the client or the producer wants to come direct, we can't say no.
Yep. Does a policy have to start being financed in year one? Or if a client approaches you and say, hey, I've had this policy for 5, 6 years, really don't want to pay out of pocket, can you guys come in then?
Yeah, it's a great question, whoever brought that up. So what I've promoted over the years is that, since I don't participate in people's commission, I don't have to be there in year one. I can jump in year eight. It doesn't matter. So what I told producers over the years is that go through your book of business. Look for those clients that are writing six-figure checks for life insurance and go back to them and ask them, are you okay continuing to write that check? A lot of people will hem and haw, but at the end of the day, they'll say, look, if I don't have to write this check, I prefer not to. So that's an opening for you and the client to go ahead and review that policy to see, does it make sense to premium financing? What a lot of my producers have done is that they'll go and they'll pick up the premium financing on that existing policy that has cash in it already. So there's no collateral needed typically, or very little. And then what they do is that they have alleviated the cash flow dedicated towards life insurance. And now it allows the producer and the client to purchase more life insurance. Because we all know that there's not one single person out there that has the right amount of life insurance. Everybody needs it and everybody needs more. So here's an opportunity to do that.
Chris, if I could ask Benjamin a question, is who's the best candidate for premium finance? And then maybe if Benjamin, you could just kind of give us an overview of some of your clients who've purchased premium finance life policies and what was their business, and how did you approach them?
So in the premium finance, like you just said before, Mark, there's a minimum requirement, but that doesn't mean that the client is the best client to do premium finance if they technically qualify for $100,000 of annual premium and a $5 million net worth. They're technically a good fit because they qualify based on the rules. And we'll just do like good, better, best, and we'll start with the best client. The best client probably will have a net worth of $25 million or more, have more than one business, like not just be in a single business doing that again and again, toothpicks every day. Just a second.
And we appreciate that, by the way, because, with a lot of producers that don't understand premium financing, especially when interest rates were at 3%, we had a lot of producers that were bringing us clients that were not qualified. So, my client's got a $2 million net worth and he makes 150,000 a year. Okay, that doesn't really work. So, by having your expertise, it really helps us out.
Yeah,
Just
and I
go
think
with
that's another reason to come to us is, we know which carriers have which limits. So if a guy's worth $7.5 million, we know there's 3 or 4 carriers that won't take him. So you're going to save yourself a lot of time.
let's just go
And a
back
lot of headache.
to the parameters for a second. A guy that has a $25 million plus net worth is involved in more than one business venture and has, let's say, a substantial portfolio of stocks and real estate. Like his financial portfolios is comprised of a lot of different things, and he utilizes leverage in different places. Like he has business loans. His real estate is not bought free and clear, and plus he has a very good cash flow. This is the best client. Now, obviously, a good client is probably somebody that has one business, some real estate, some stocks, not a very leveraged guy at $50 million net worth. The client that technically fits the bill is a $5 million net worth with enough money to pay the interest, and we'll just hope that everything just survives. But that's not the best count. Somebody, yeah, technically we can do it. That's on that part.
Yeah, I'm kind of thinking that a lot of brokers out there know really, really wealthy people, but are a little bit reticent to approach them because they don't know how to get in. What's the catch with these really, and so they avoid the really wealthy people. But this is a great approach for people that maybe, I mean, everyone has the wealthiest person that they know. They may not play golf with them, but they know a really wealthy person. We could all say we all know someone that's worth 20 or 25 million or 10 million or 5 million. We all know somebody. At least we are an acquaintance with them, that we have their phone number. But what do you approach these folks on? And so, yeah, I'm not going to approach them because I really don't know how to get in with them. But this is a great idea. This is a great idea.
Yeah, one more question. When interest rates were very low, there was a lot of people doing this and maybe doing it improperly. So for those clients that come to these brokers and say, "Hey, I'm kind of underwater in this premium finance deal," is there anything we can do to help?
Is that a question for me, by the way?
It is.
So technically speaking, let's just unwind for a second on the in-force business. In-force life insurance can be, on the one hand, it can be the best thing ever. On the other hand, it could be the worst thing ever. Okay, we have the two sides of it. A client paying out of pocket on a 10 pay $1 million a year in year three. If they do premium finance in year four, this couldn't be a better deal because you have so much cash value in the policy. You can probably upsell the client millions of dollars of insurance, and everybody's just so excited. On the other hand, if you have a premium finance structured deal 6 years ago, and the client is underwater on his collateral portfolio, and he's paying interest through the roof for the past years, and he thought it's going to be free, uh, it's going to be very difficult to get everybody to a point where everybody will be excited. What we can do is sometimes like have a good discussion with the client and go through and resell the same product, and sometimes restructuring on based on riders or strategies, depending on whole life versus IOL, these two things. And I've saved some very, very big portfolios over the years. We're just restructuring, whether it was reducing policies, just changing a strategy, like instead of a multiplier, we'll just do a regular S&P zero floor and 10 cap, whatever it is. Having the right expertise and understanding how premium finance works at the basic level is something that is very, very important. So that's one part of the answer. The other part is I've had multiple brokers that contacted me over the past probably 6 or 12 months, and I've saved a lot of in-force business that wasn't supposed to be financed at some point, but the client decided that they needed the cash flow, whatever it is, and they have very excited clients. So if you have anybody that doesn't want to pay their premium or is having struggles paying the premium, doesn't know exactly what they're doing when they're loaning from their policies back and forth, but just have a good conversation about it. And I think we can have very excited clients after that.
Great. Chris, I think we're up to time unless you have one last
We're
question.
getting some pretty detailed questions about, Mark, your loan to value ratios on ETFs versus blue chips, yada, yada, yada. And I think that's a good opportunity on May 14th to really get into that rather than now.
Right. Okay.
Really, because there's a lot that goes into that. So we'll touch base on May 14th.
Great.
Great.
Now, I will say one thing. I will say that I myself, I think Mark can attest to that. I don't like when you use collateral to purchase a life insurance policy. I don't like that. I like when everything is just free and clear because just to start from the beginning, involving the more you involve in this transaction, the more things can go wrong. So just imagine paying down whatever the shortfall would be instead of posting collateral. You're basically the only thing that can go wrong here is your interest rates or your dividend. That's all there is. There's only two variables. Just imagine adding to that Tesla stock that goes every day up and down $100. Like
Yeah.
you'll just go crazy.
Yeah. Yeah.
Yeah.
Yeah. Chris, can you leave us as panelists on for a moment after the call?
Yes.
Okay, great. I want to thank everyone for being on, especially our two speakers, Mark and Benjamin. You guys were great. We look forward to helping those brokers that are on the line with some questions and some cases. We'd love some cases for you. And please mark May 14th. There'll be more detail about that event. Okay?
Yep, we will
Thanks.
send out a registration email for that. And Elliot, you are correct. Wintrust does not participate in the commission. They do not go on the application.
Great.
That is correct.
Thank you, guys.
Thanks,
Have a
guys.
good day.
Thank you.